My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today our special guest zooming in from the Big Apple, New York City. We've got Big Mike Zlotnik, who is a very accomplished real estate entrepreneur, a syndicator, a fund manager, a fellow podcast host, a guy who knows a heck of a lot about a commercial real estate, especially in the multifamily space. And today we're going to talk about something really important, especially in today's environment, which is, what I think, Mike, you call it deep value buying. Is that what you're calling it?
Yes.
Yeah.
Yes.
Okay. So Mike, welcome to the show. Great to have you.
Dave, thank you so much for having me. Appreciate it.
So Mike, let's zoom out for a second. Talk to me a little bit about what Tempo Family is, what you focus on, what your main bread and butter is in the real estate investing space.
Sure. So the best way to think about us is we marry money and opportunity. We are capital partners on deploying capital on many great deals. So we're very well networked. We've been doing this for years through mastermind communities, conferences, build a very strong network of operators.
Okay, so you find the operators and then you help them to fund their deals.
We basically bring capital to their deals. So we underwrite, we review, and we are very broadly diversified. We have folks in multifamily, industrial, open air shopping, storage, number of niche strategies. And then on the other side, investors work with us to write a check into one of these deals that makes sense to them. Some folks looking for income, some folks looking for great tax efficiency, some folks are looking for both, for growth and income. And if they like a fund, folks can go through a fund. If they like one-off deals, these are one-off syndications.
Very good. And how long have you been in the business for?
I'll just add one quick item. We come in as a big check. We step on sponsors' toes pretty hard to negotiate best terms for our investors. So when an LP comes in and gives them a $100K check, your negotiation leverage is exactly very little. When we give them an $8 million check or $10 million check, our negotiation leverage is pretty significant.
Yeah, no, it makes a ton of sense. So give me an idea how long you've been doing this for and how many different projects are you involved in at the moment?
So we've been doing fund investing in one-off deals since 2009. We've done a lot of debt investments also, a lot of private credit lending as part of the strategy. Commercial real estate, we've gone sort of hot and heavy since 2017.
Okay, very good. And over the last few years, a lot of the folks especially in multifamily have taken quite a hit. How has this affected some of the projects that you guys have been involved in?
So the short answer to the question, if you've been in this business, not just multifamily, if you've been in commercial real estate and you claim to have no issues, your name is Bernie Madoff, right? It's impossible. So the market has reset substantially, and yes, some of the projects have their struggles, and it is a tsunami wave that hit the entire CRE industry when Fed hiked fast and furious and kept the rates higher for longer. So we're navigating these challenges project by project. Some are going to be totally fine. Some may not survive. That's the honest and open answer.
Yeah. Well, that's part of the advantage, I think, of what you guys do is you're not just in one or two deals in one specific sector. You kind of do a broad range of different things, if I understand correctly.
Yeah. And what's the beauty of what we do, as our relationships exist and some of these projects may have challenges, we see the other side. We see the deep buys today that are already happening. We see the discounts. It's almost like if you were to sell in this market, it's not a good time to be a seller. But if you want to be a buyer with fresh capital, it's a phenomenal time to be a buyer. Almost historic opportunity to come into this dislocated, unpopular, unloved market and deploy capital on phenomenal terms. The changes versus a couple of years ago are staggering. The cap rates, you see deals with a cap rate difference of 3% from where they were before versus they're now. Used to trade at 6 cap, now it's trading at 9 cap. How crazy is this?
Yeah, that's huge. So, well, let's talk about that. That's the whole deep value buy thing. That's something that you're paying a lot of attention to these days. So, maybe walk me through that. Walk us through how you guys are looking at deep value buys.
Sure. So you got to look at some of the traditional metrics.
Yeah.
Before, it was sort of momentum buying. People were buying because the markets were moving higher. Today, you're looking at the most basic fundamentals of buying. What are you buying at relative to a reconstruction cost? A very simple way to look at this. What are you buying at what cap rate you're buying versus the cost of capital? Do you have a positive spread between the cap rate and the cost of money? And we seek to get at least 2 percentage points positive spread. We've seen spreads even higher. But that's very basic because it creates safety, margin of safety. You're buying at 9, you're borrowing money at 7, right? Can you create a fixed rate debt environment with downside protection, right? Before, of course, the risk today that the rates are going to spike are way, way lower when they were very, very low.
Yeah.
So you could take a variable rate mortgage today and feel pretty decent about it. But if you want more downside protection, can you get it at a at the fixed rate? Next, we look at leverage. So leverage, people used to take great leverage, 75, 80%. Today, well, what's the current leverage? Can you do it? Can you still get a great return with 60% leverage, 65? As crazy as it sounds. And if your numbers pencil at a low leverage, great positive spread, great cost relative to the new construction value, and look at the current rents, not project great rent growth, but see where you are today, what you can do with lowest risk and easy value add, not a hard, but light value add. We've looked at these numbers. Can you do some improvements on a property? Let's take example of multifamily. We did early in the year. Property has old inefficient ceramic heaters. Can you replace them with new energy efficient? Oh, and can you get reimbursement from the utility company to offload the grid? Right? And you can get 75% of your investment reimbursed and get a letter from utility company affirming that. Right? And that can save a lot of money. It's a green project. You get reimbursed. You get easy reduction in costs. So these type of light improvements make a lot of sense. So it's fundamental investing. It's the way you look at the stuff. Many years ago, can you create cash flow safety? So when you start with the spread, when you're buying at 9 or 9.5, and you're financing at 6.5 or 7, you have a big positive spread, a couple hundred basis points. Your cash flow is guaranteed to be there from day one. So before, people used to buy deals and get no cash flow. Today, it's a requirement. I don't want to hear the deal has no cash flow. And people pitch us ground up construction. I tell them I can't get a discount on ground up construction. You're speculating. I'm investing today. So the approach has changed drastically because we're looking at investments. And you're looking at the asymmetric risk versus reward profile. So you look at risks. What could go wrong? A few years ago, everything was underwritten for perfection. You had to get the rent growth push. You had to execute on time, on budget. So many variables had to be set for perfection. Today, how much reserves do you have? What else you could do in the project? What other areas of the project you have that you haven't even counted on, right? And can you buy a property? Give you an example. We're working on a deal right now that is 84% occupied and it's 9.25 cap rate, and we are locking in fixed rate debt at 6.5. You start looking at all these margins, right? So you have 16% to lease up. You have number of these other categories that are very basic fundamental underwriting requirements. Then you obviously look at the property. Location is still true. Where are you buying, right? Before, people went to these class B, C properties, bad location to get better cap rates. Today, you can get phenomenal deals. Just you got to find motivated seller situations. These motivated seller situations are happening left and right. Not distressed asset, but a stressed, tired, motivated seller. Why? Because the bank is yelling at them, because they can't pay the mortgage, because they've owned the property for too long and they have to exit. Even commercial sellers, they've owned this thing for too long. They should have sold a couple of years ago. They didn't. They're past maturity of their fund. They got to liquidate, right? Find that situation on a commercial deal and you can make a better deal. So it's happening. The stress levels have obviously gone up on multifamily. Some strategies are doing just fine. Like we have this great deal I mentioned to you. It's an open air shopping.
Okay.
By the way, that asset class has held up remarkably. This is a huge contrarian play, which has been kind of a secret area that has not seen this massive correction because there's been
So
no
open air
supply.
shopping, do you mean like a strip mall? Is that what you're talking about? Or what, paint me a picture of what you're talking about there.
It's a strip mall like. Sometimes you have courtyard, you have outdoor seating, right?
Yeah.
For restaurants, typically it would be service oriented, ton of food concepts and service concepts.
Okay.
So, in some of these open air shopping projects, you can have an anchor grocery type of store, like Aldi's. You could have Targets. There's all kinds
Mhm.
of these things that essentially they bring the traffic because people go there anyway.
Yeah.
And service oriented, people still need to get their nails done or get their hair cut, or people still need to eat. And if you're located really well in a good area where people want to go anyway, this is an added bonus. So we've really loved this strategy. Continue to do open air shopping. And by the way, that strategy has been remarkably trading always at very low leverage, 60 to 65%. The new deal we're doing is 57% leverage. So when
Wow.
you look at it that way, can you still make target returns of very high teens, maybe in the 20s, with that low leverage? It the only way you can do it is by buying right. If you buy it right, all the numbers click in. They almost automatically plug in, and you can run stress tests. You could run sensitivity analysis on rent growth, on cap rates. But today, the way to think about it, these deals are beginning to come forward. It's not a volume game; it's a precision game. But that's the way to think about it. Don't think about I'm going to be late to the deal. Look at the deal. Is this a great deal? No. Next. Is this a great deal? No. Next. And the options are the buyers have it's buyer's market. That's the bottom line.
Yeah, well, very well said, Mike. Thanks for explaining that and what the whole deep value buy means to you. Makes a ton of sense. Now, and you're looking at multiple different asset classes, not just apartment buildings, but also open air shopping. And what else do you guys like to invest in these days? What are some other hot asset classes that you're really focusing on?
Very, very popular today, private credit. Right? Private credit has been very simple, backed by real estate. So pretty much all we do is real estate. Some people do other alternative investments. I have plenty of knowledge in other strategies, but we love to do private credit. So you can do private credit today, first lien lending. You can get interest rates, let's call them 14%, where a few years ago when the rates were lower, it was sub 10. It was very, very competitive. So you have primary debt that yields 14%. Also, you can do secondary debt. We've done quite a bit of what I call in recovery capital, mezzanine debt. So you don't come in first position, but you come in ahead of all the preferred equity, ahead of all the common equity, but behind the mortgage on a
Hmm.
deal that's equity rich but cash poor. There are still enough of the situations where they bought it at the right price, they've completed renovations, and if they try to sell now, they're not getting the right price. And
Right.
their liquidity is tight. They got to refinance. So you can come in, give them some recovery capital to complete the business plan to get them to either a refi point with an agency debt or a sale timeline. So when we do these type of loans, we typically want to do it for 2 years. And
Hmm.
the beauty about current environment, we require 2 years of interest reserves and escrow. How crazy is that? So if
That's
we,
pretty
we do
good.
a loan, we do a loan, just give you an example. We'll do a loan at 20% interest rate, 12% current pay, 8 deferred. You must have 12% for 2 years front funded. And if you don't have it, we will underwrite. If you have enough room in the deal, we will overfund, force 2 years of interest and escrow, be in the next behind the primary debt position. But now you have the capital. You don't have to worry about the payments for 2 years. Execute a business plan. But we are in a position. It's kind of crazy. But these mezzanine debt, we really like to call it mezzanine debt, although some people do it as pref equity.
Hmm.
The reason we do that is for contractual obligation. You can ask for personal guarantees. You can ask for additional collateral versus pref equity. In some cases, it's fine, but we prefer mezz debt. So on a mezz debt front, you could actually get great terms. You can also ask, by the way, for an equity kicker. Most people don't understand this, but you could get 20% rate of return, fairly decent downside protection of your principal with the personal guarantees and additional collateral. And you can ask for another 5% upside in the project, or maybe 10%. It depends on the project. And the crazy part is that the capital available to fund that is scarce. A number of people who are looking for this capital is very significant.
Yeah. So, Mike,
So
another part
the
of your
power is with those who can actually bring this capital and negotiate the right terms. You are very carefully trying to back the right jockey. You do not want to back the wrong jockey who has failed before and they cannot complete the business plan, for sure.
So the other side of your business, Mike, is raising capital. Do you tend to work more with institutional lenders, family offices, individual LPs? Who do you guys tend to work with more?
Mostly individual. Our whole business model has been built on individual, although we do have some small, very small institutional, what I call very small, where they write, a few $1 million checks. Typically, these are not big institutional family offices. So some people call themselves family offices, small family offices. They run their own mini funds of funds. We do work with other fund managers who raise capital too. So when we have a project and we want to have a good amount of capital raised, like $10 million, $9 million, I usually pick up a phone and I call a couple of friends who are fund managers themselves and say, "Hey, you wanna bite a piece?" And most of them will look at the deal and they love the deal. Say, "Yeah, I mean, count me in for 4 million or 2 million or whatever." So if that's called small institutional, then yes, it's small institutional. They are fund managers in the right of their own, or they manage their family capital. So
Okay. And when it comes to finding new LPs in today's environment, is that more challenging than before, or you guys still got that pretty dialed in?
back to the same statement. If you
Yeah.
haven't had problems and if you're still raising like you did a couple of years ago, your name is Bernie Madoff, right? The industry standard, the capital raising has got 3 times as hard than 22 versus 24. Now with 25, we're still collecting data, but it's way harder. No question about that. Why? Because a lot of investors who redeployed the capital they exited deals from in the past, they redeployed in 21 and 22. Now they don't have that money to redeploy. They are hoping and praying that money will come back. So the same universe of investors who had liquidity, who had velocity of money, is now stuck. They don't have that money. Some of them have fresh capital coming from their other businesses. If you're a doctor, if you're a business owner, if other stuff is doing well, you continue to get investable capital from time to time. But it's gotten way harder. We, of course, continue to appeal to, let's call it, those areas where the risk has increased and some investors are beginning to realize themselves. It's difficult to convince investors. I'll give you a hint what I'm referring to. So I had a call from a good friend in December of last year. He calls me and says, "Mike, I've got so much in crypto, I can retire many times over. What do you got in real estate?" Crypto has done very, very well. So he's sitting on heavily appreciated position and he has the wisdom to realize, because he's actually a real estate guy, to realize that he's got to take some chips off that table and put them in real estate, reduce the risk. He will still do just fine if the crypto continues to do well.
Yeah.
The same is true, by the way, in stock market, precious metals. Now, you could continue to argue that you could have AI boom go into infinity. We've seen 2000 boom and some correction afterwards. I don't know. Maybe it'll continue to keep climbing and climbing and climbing. But if you look at S&P 500 PEs, they're beginning to get into the stratosphere. At some point, valuations begin to exceed the fundamentals, and then the risk level at that point has gone to a, let's call them, stratosphere. And those with prudency begin to take some of those profits off and redeploy the capital where the values are great, where the deep value exists. So it's a hard lift. It's education, it's communication. Some people reach out to us proactively, some people don't. So it's work. It's gotten way harder, but
Keep on
that's what the
chugging.
world is like.
So what are you finding that's working reasonably well these days for generating fresh investor interest and fresh investor leads?
It's another conversation. I would have to bring our marketing people. They're working very hard to innovate. We are diving full speed ahead into AI. That's all I'm going to tell you. So we are learning new ways, what else we can do to enhance marketing efforts. What used to work, it's gotten harder to raise from. So the same Let me put it this way. When you go on Google, the Google used to run the normal search. Now they are piloting live right now as we speak to put the Gemini as an engine for Google search.
Yeah.
So if you did well in previous version of Google, now you may be nobody, right? So it's a rapidly evolving world. Ultimately, it's the same approach. You basically try to demonstrate authority, credibility, expertise. Next, you try to connect with people, do something for them, build reciprocity, help them learn, get better at investing, and then one day they consider having a conversation with you. So these techniques where if people respond to an ad where they say, hey, you're going to make 25% return, these are the different kind of folks. We want the folks who are not responding to these aggressive ads. We want folks who understand what is conservative investing. They're looking for more predictable, let's call it well understood risk. By the way, there's a complete misunderstanding. Most people think this, and I'll tell you it's completely wrong. People say, well, in order to get high returns, you got to take high risk. It's actually backwards, right? In order to get high returns, you want to reduce the risk in creating asymmetric return profiles. So we're looking for investors who would like to be conservative and more defensive in their nature, but they are open to the idea of making better returns through better deal selection. So today, that's kind of the ecosystem. I honestly, it's a lot of exploration today, a lot of trial and error. If I knew exactly how to do this, I'd probably be teaching, I don't know if I'd be teaching a course on this, but we'd probably be doing a lot more deals. We're doing about one deal a quarter because it's gotten harder, and we want to do high quality deals anyway. So this is not a race, this is more of a precision, and just continue to educate, continue to talk to investors, and continue to, and by the way, I've had conversations with people with struggling deals. We're open, transparent about them, and we tell them how it is, and they want to know, when am I going to get my money back and how much? And you tell them honestly, we don't know, right? And if somebody's telling you for sure, they're telling you baloney, most likely, right? So it's the world where it's been a lot of uncertainty. I mean, trade wars, real wars in the world, all kinds of other volatility, and things that hopefully will settle down at some point. We're still trying to assess what this wonderful thing called AI will do for us. Yeah, it's given us 1% GDP growth in the past. Will next year be 2%? Or what's going to happen, right? Are we going to be at risk of Terminator, the movie, and AI taking over? So a lot of uncertainty. Investors are very cautious. Fed policy is still paying folks a lot of return for taking no action. So as interest rates stay elevated, consideration for deep value investments is still, people, I'll take my 4% and do nothing and sleep well at night, right? It's just, it's that kind of environment.
Awesome, Mike. I'm sure there's going to be some folks wanting to connect with you and find out more about what you guys do. Where should they go?
I'm a Big Mike. I'm 6'4", and I have a podcast with a cheesy name. There was no better way to call my podcast. As a good friend said, you're a Big Mike and you're a fund manager. So it's bigmikefund.com is the website. And if you misheard it, if you forget the D at the end, then you go to bigmikefund.com. I promise it's not a kinky site.
Awesome, Big Mike. Thanks for being on the show.
Thank you, Dave. I appreciate you.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.